thanks very much. What I'd like to spend some time talking about today is the journey that Cuscal's been on over the last couple of years, and particularly the last 6 months. But I don't want to dwell on that too much. What I want to focus on is why we did that and why we made those changes. Talk a lot about what the changes are that we see happening in payments. You've heard already this morning about a bunch of names, some of which you've heard before in payments that are claiming to revolutionise the world, and you're going to hear about a few more in the next 40 or so minutes. And I guess to begin at the end, I think there are lots of things about the changes in payments that have the potential to scare incumbents. And certainly I feel that a lot. I think that we have traditionally, as ADIs and deposit takers, enjoyed a privileged position in the collection of money and the movement of money, and that is clearly under threat and clearly changing. There are lots of new entrants, there are lots of people moving into the space. Some of them will be massively successful, and some of them will fail spectacularly. Some of them will present partnership opportunities, and some of them are best ignored. We see ourselves as playing a role in partnering with some of those, in supporting industry partners and creating some of our own services. But the things that we see as being critical to that journey are, firstly, an open, modern, flexible architecture on which to build, because we don't know what the next win is going to be, but we do know that we need to be in a position to engage with them. So we need that open, flexible architecture from which to build. To be prepared, and a couple of speakers have already talked about this morning, to be prepared to innovate, to be prepared to make mistakes, to fail and to fail quickly, because the first thing we do won't be the best thing we do, but it will be a step along the journey, particularly in an uncertain environment. And last but not least, as smaller organisations, we must be prepared to collaborate and partner with each other and with non-traditional payments, non-traditional players. Just a little bit about Cuscal. We are owned by about 90 organisations. The core services that we provide to our customers are in the areas of switching, card issuing, settling and clearing, and increasingly in fraud management. And we've got a range of names and a number of others that are in this room that we provide those services to. And a key part of our differentiator is that we're owned by our customers, much as many of our customers are also owned by their customers. And we think that owning critical infrastructure is an important predictor of future success for us and our customers. It's been a big year for us. We were certainly very busy over the last couple of years and over the last year or so particularly, and I've drawn out a number of the other big projects in switching that have occurred in the last couple of years, or the last handful of years. SPS, as you know, was created by Bendigo, Adelaide Bank and MasterCard Customers Limited. They took 6 years to build their infrastructure, and they've moved 5 customers onto that infrastructure over 6 years. American Express recently replaced their switching infrastructure in Australia and globally. They only had to connect to the merchant side. They had no data to convert. They had one core banking system. They were only doing transaction processing, and they launched that over more than 4 years. And our little project, we connected 16 core banking system interfaces to our platform. We migrated about 1,300 ATMs in 12 months across 11 different software builds and about 35 different ATM models, because we like to make things more complex. And then we migrated just under 90 customers, about 230 bins and 2.6 million cardholders in just under 5 months. Originally we were planning on doing it in 12, but our circumstances changed and we had to do it in 5. And at the same time we built and installed a fraud prevention solution which rolls across our EFT platform and increasingly our payments platform as well. Look, there's some numbers there on the board about the things that we achieved and some metrics in the program. 35 ATM models, as I said, about 17,000 tests on our ATM network, and about 45,000 individual tests as we began that migration process. Clearly, in any program of that size and complexity, and particularly one that was cut in half by 6 months, there were a few bumps along the way, and we certainly had a couple of those. Our focus, after we managed to kind of complete that program and deliver stability to our customers, our focus is on innovation, on seeing what we can do with that platform and supporting our customers. I have to say we caught up on a fair bit of sleep. But the other thing that we needed to do is strip out some of the complexity that we built into our business. We migrated many of our customers on a like-for-like basis, and I don't mind saying that there are some things that we would do differently. For example, across 90 different customers, we have 1,800 different authorisation strategies. 1,800 of them. Now we should probably have about 50. We should say pick 10 of these, but no, we created 1,500 of them, and that makes our business more complicated, and our progress over the next couple of years will be about stripping out some of that complexity that we created. How did we do it? Look, it was a massive technology change project, but it was more than anything a change management project in terms of aligning our internal stakeholders and aligning the agendas of our 90 customers. So we did a bunch of things differently. It was a highly visual program, and what you can see a picture of there is a representation of a big roadmap in our building that took up the entire floor, where we tracked our progress in real time. We used lots of other tools. We moved from essentially an 8 to 6 operation to a 24/7 operation, and we wanted to change the heartbeat of the organisation so that we were reflected in becoming an always-on environment. So you can see in the top right-hand side there, we've got big screens throughout our business that provide feedback in real time about what's happening inside our network. And some of the other things that we built is this little application in the corner called Pocket Switch, which gives us and ultimately our customers a real-time view in real time into what's happening in our environment and what patterns we're seeing. So it was a massive change agenda for us and a massive program, and we used lots of different tactics to get it across the line, particularly with a fixed deadline, which for those of you that work in IT, fixed deadlines are sometimes inconsistent with success, because you do like to push things out a bit, and we couldn't do that. Why did we do it? Look, the switch itself for us was an enabler to do several things and have options about the way that we did those. Our customers were looking for us to be more flexible and faster and cheaper in the way that we introduce change. And one of the features of our previous operating environment is if we wanted to make a change, we had to build a business case in order to deliver that and make that change across our entire customer base. Whereas what we're now able to do is make bespoke changes for individual customers if they want to see that happen. Previously for us, switching was a variable cost, whereas now it's a fixed cost. So if we bring on new business, theoretically that new volume, all of our customers and the owners of our business bring the benefit of that volume. So there were a range of reasons why we did that, but it also gave us, as I said, the opportunity to put in place some flexible infrastructure to replace what was becoming quite an old piece of technology and to give us the basis to innovate into the future. We talk about making payments easy, accessible and secure and to becoming a leader in the medium term. Our strategy is broadly in a number of segments. Clearly we've done a fair bit of work now around developing our infrastructure. We will continue to focus on replacing and rejuvenating and regenerating our ATM network, diversifying our card offerings, building our fraud prevention technology, particularly as we move towards real-time payments. The faster money moves, the better your fraud prevention needs to be. And as we're hurtling towards real-time, we need to make sure that we can stop payments that are mistaken payments or fraudulent payments before they become irrevocable. Clearly, as I've said, I'll talk in a little bit in a second about real-time payments and the move towards real-time payments, and a little bit about where the RBA is going there, and focus on mobile payments. not just with our existing customers, but by building new partnerships. So, I guess that's a little bit about our journey and why we wanted to make that change. I want to talk now about what some of the changes are that we see happening in the payments marketplace. I talked a couple of years ago at the TSWG conference, and I made these kind of observations about the things and the kind of trends that we were seeing. And I know we've all heard from speakers this morning that all of those things are bearing out, but particularly in the area of mobile payments, where we're starting to see some real disruption of the role of the existing players. We've heard a lot today about the changing expectations of consumers. Ubank, like brands, is a great brand, and is a great bank, and has built lots of really functional customer channels. A great internet site, a really simple product offering, a 24/7 call centre, great rates, click to call, Skype to chat 24/7, but no mobile app. Where's the mobile app? And you can see the feedback from their customers there on their Facebook page. Increasingly consumers want everything. They want it now, they want it good, they want it on Android, they want it on iOS, and they probably want it for free as well. And that's the environment that we're playing in. We've talked this morning, I think, at length about the acceleration in the growth of the online channel and mobile channel, and you can see that it took Westpac 18 months to get to 1 million active internet banking users, and only 30 months to get to 1 million active mobile users. And the growth in online transactions in the dark green bar versus the growth in mobile transactions in the light green bar, the shift to mobile and the shift away from branches is incredibly fast and exponential. As we look around the market at all of the things that we see and all of the things that you've heard about and we hear about, we see developments falling into 4 main categories. And they are retail payments, so mobile, NFC, and cloud-based POS are removing friction at the point of sale and removing the requirement for people to present devices and PINs and signatures, but also creating opportunities for merchants and other providers to make targeted offers to consumers, coupons and loyalty. The second is in payments facilitation, so making payments easier and faster between any combination of payee and payer, not just using BSB and account numbers, but increasingly using things like Facebook, telephone numbers and email accounts. In the bottom left-hand corner, there's a cluster of developments around the intelligent banking and personal financial management space. So turning payment data into insights and answering questions like, where is my money going? How much can I spend? Or how much do I spend on food and alcohol in any given week? And sometimes the answers to those questions are not the ones that we like. And then finally, on the right-hand side, the bottom right-hand side, customer engagement, giving consumers new ways of engaging with their financial institution. So, not just where to find an ATM that is in service, but can I change my PIN there? Can I make a deposit? And is it working? Or, click to call, alerts, and other information feeds. And so we see all of the developments falling into one of those 4 key areas. There's been a few discussions this morning about Simple, but here's a short video from Simple which brings together all of those 4 payments innovations into one package and delivers that to consumers. Okay. Sorry. You're right. Do you know any clean jokes, Terry? Look, let's talk about mobile payments. There are lots of options in mobile payments, and here are the main ones and examples of each. There's no right answer about where this is going. There are lots of wars that are being played out now between the schemes and the FIs. Will Apple let NFC into their devices? Between the telcos about giving access to the secure element or the SIM, or whether they're going to put an NFC chip in the phone. And you can see examples of innovation there across the value chain. The most important thing, I think, is about getting in the game and getting in a way that makes sense for you and your customers. And the place you start is not always the place that you'll end up. So, for example, Kaching started with NFC and application-based P2P payments, and have subsequently added Bump location-based P2P to their offering. Starbucks started completely differently with a barcode, with a QFC barcode, and have expanded into mobile point of sale via Square, and then location-based payment method selection via Apple Passport, so that if you go near a Starbucks store, then automatically the Apple Passport will come up and present the Starbucks barcode for use. So there are lots of places to enter. I think that the most important thing is about getting in and starting somewhere, and that gives you a position to learn from, gives you experiences, and lets you understand where to go next. Here's another example from Vodafone. Vodafone and Visa have launched an NFC wallet. It'll be rolling out in early 2013, obviously only on Android devices. Initially using a prepaid mobile, a prepaid card, which is kind of preloaded onto a digital wallet. You need to upload money onto that prepaid card and then transact anywhere. Over time, of course, the digital wallet will migrate more broadly to the phone, and maybe at some point in the future onto the iPhone 5, and then the prepaid card will no longer be required. Here's an example that's slightly closer to home. Ourselves and other people will be working with Visa to bring this development to you and to our customers. So V.me is an online digital wallet that will enable you to preload or load your cards, not just Visa cards but also MasterCards and Amex, to preload all of that information into a digital wallet once and only once, as well as things like your billing address and your shipping address and the PANs and the expiry dates, and give it all a password that's easy to remember, like your mother's maiden name or the name of your cat. And then once you go to check out, rather than having to enter all of that information initially and re-enter all of those fields, you'll just click the V.me button, enter maybe your password, the name of your mother-in-law, pick which card that you want to use, whether it's a Visa card or another card, and then complete the purchase. The aim being is that it makes the process of checking out faster and simpler, results in less abandoned transactions at the point of sale by the merchant, and it also positions Visa and its cardholders more strongly to move that whole experience online and into a digital wallet at some later point when the market evolves further. There's lots of players in mobile acquiring, and moving from the kind of clunky-based mobile POS solutions with an antenna right through to cases that slip onto an iPhone case. You've heard a couple of times this morning about the Square dongle, and the interesting thing is that it's easier to sign up for Square and take money off of people than it is to get an application approved to make a deposit into a bank in Australia. So there's examples of where the regulators aren't actually making things easy for people. I think the most significant development in this space is the Commonwealth Bank Pi platform, which is a merchant-facing platform, an open architecture, so it's got a base piece of hardware, and then it will enable apps to be loaded onto that device to, point of sale systems, inventory management, checkouts, internet banking, ability to accept payment online. All of those apps will be loaded onto that platform and provide innovation to customers. But it will also talk to CBA's Kaching and create networks. So, if a Kaching customer is going into a store or a merchant that's using Pi, then there'll be a whole bunch of functionality that's opened up there as well. And I think one of the first cabs off the rank is bill splitting. That whole process of splitting a bill, assuming that people are using the CBA app, will become much easier, and merchants don't have to worry about it. It can happen in the background. So there's lots of developments and movements in the mobile acquiring space. Moving money is becoming easier and faster, and not just restricted to the existing players. So there are a bunch of different examples in the marketplace. This is just one of them, where new players are entering the marketplace and making it easier and faster to move money around. So Droplet, which is based in the UK, you pre-fund that. It makes its money wholly and solely on the float that it retains, and presumably a bit of breakage and shrinkage along the way where funds are kind of left there and never withdrawn, and it enables you to move money between Droplet customers in real time by banging funds together or just by using Facebook or Twitter. Clearly there are risks for existing players. One of them is the loss of the float revenue that you use to fund your loan book, and the second is potentially the loss of your position as the main financial institution. We were going to hear before about Simple.com, but Simple.com brings together all of the things that we've talked about in the PFM space. So if I make a payment using my smart card or my phone, it can keep a record of that. What I paid for it, whether I left a tip, to make a personal note, like particularly useful if it was, for an expense claim or something like that, where I spent that money, and then that rolls up in further detail. So it then enables me to collect all of the things that I spend in any given month and give me a real-time view of how much I'm spending in each one of those categories, and then ultimately, how much money I have left before my next pay rolls in. So, this product is bringing together lots of those different features, presenting them in one interface and one app to consumers. Here's another example, slightly closer to home. This is Sydney Credit Union's new app, which is brought to you by Vermilion. It does a range of things, pushing special offers, the location of the nearest ATM and branch, access to mobile banking, budgeting, making applications, where's the nearest branch or ready ATM, and you can even put pictures of your children in there as well. So, even close to home, we're seeing developments in this space too. PFM is rapidly gaining popularity in Australia, and these traditionally have been brought to you by organisations like Yodlee and Mint, so third-party organisations. But increasingly, all of the big banks, and now organisations like Pocketsmith, are delivering PFM solutions to their customers. So, to collect the information that Westpac or the NAB have about where you spend your money, collect all of that, encourage your customers to breach the EFT code of conduct by putting in their access code to somebody else's internet banking, scrape that information from all the other places, and then present that back to them, giving them insight into where they've spent their money. National Australia Bank recently launched theirs. It cost them reportedly $1 million to develop. Within 3 days of launch, they had 30,000 active customers. Look, I've used all of these. I've used most of the main ones. I've used Mint, ANZ Money Manager was one that came out a couple of years ago. I think they're getting much better. The first ones were really clunky and didn't work very well, but I think the next generation are improving much more and giving your consumers insight into where they're spending their money. The risk is that if you don't do that as a main financial institution, then somebody else will present a PFM opportunity to your customer like Mint, and they make their money by sending targeted offers to your customers, encouraging them to move their banking elsewhere. So this is a real place where institutions need to play and need to build that capability. We've heard a little bit about Google Wallet today, and I just want to talk to you in a second about how that works in a bit more detail. Google, as you know, isn't planning on making its money from banking, it's planning on making its money from data. And I think what they're planning to do with that data poses real risks for existing card issuers. So card details no longer need to be loaded onto the phone. They are loaded up via a cloud onto a secure server, much in the same way that you do now with PayPal or with the V.me product. What they don't tell you is that the Google Wallet actually does contain a card. It's got a prepaid MasterCard loaded into there, which is required to enable it to do what it does. The user then selects the card that they want to use at the checkout, they tap their phone, and Google's prepaid MasterCard is charged by the merchant terminal. The transaction is then routed to Google, who have full view of the transaction data which is passed to them by the merchant, and then Google then take on the merchant role, make a charge against the user's selected payments card in the cloud, and all the issuer and consumer see about that transaction is the name of the merchant in the form * Google and then the original merchant name. There's a few questions that arise from that. I mean, obviously, it provides an easy and quick way for existing card issuers to get their cards onto a phone and onto a wallet. But what does it mean for an issuer's ability to prevent and mitigate fraud if all of the transactions come from Google? What ability does it have on the issuer's ability to use transaction data for things like behaviour analysis, predictive modelling, and offers and rewards if they don't have access to that data, if that data is collected by Google on their behalf and not shared with them? And finally, how do issuers remain top of wallet? So there's a lot of talk in the plastic card world about how you activate a card and how you get it at the top of wallet, and the same principles apply in the virtual world too. How do your card holders and how do you influence what card remains at top of wallet? Is there a shift in the balance of power between who gets to decide who sits at the top of that wallet and which card is presented first? And I think the Google Wallet proposition has got real challenges for independent FIs and a real challenge to their role in the payment space. What are some of the other game-changing initiatives that we're seeing? Well, clearly, shifting to a more secure and faster infrastructure. NFC is faster for customers at the point of sale, and once it goes to mobile, it will be even safer than cards are now. The RBA, of course, is asking for innovation and speed in the form of real-time payments. And BPay and the four major banks had a pretty good go at the Mambo initiative, and ultimately the complexity associated with that initiative meant that it ultimately failed, but it did have the potential to be a real game changer in payments. Looking at number 2, new entrants. New entrants have exposed gaping holes in the current payment offerings and will potentially change the way that small business acquiring works. Square in the sense that it makes it cheaper and faster to accept a payment, and Dwolla, which we'll talk about in a second, basically stripping out MSF out of the equation. Thirdly, new entrants are creating their own solutions, and we've talked about Starbucks already and the role that they're now playing in prepaid. Closer to home, most of you will know that Qantas is now proposing to issue prepaid cards to its frequent flyers. Virgin is about to do the same, and most people are aware that Woolworths very shortly will start converting their everyday rewards cards into prepaid cards as well. So, you know, if you add up all of the customers of Qantas, Virgin and Woolworths, that's a lot of new entrants into the payment space. And finally, as we said, you know, new players like Mint and Google Wallets, they're not so much interested in the payment or in the merchant interchange, they're more interested in understanding the data and how they can make money out of that data. So how much time do we have? Looking at, I guess, the three key initiatives that we're talking about today. You know, in the business intelligence and data space, we know that the big four banks are already doing some highly intelligent and targeted work about acquisition and retention, leveraging big data, and we're going to hear more about big data in the next day or so. So where are you spending your money? Where are their customers spending their money? You know, where do they have a personal loan that we don't have? Where do they have a mortgage that somebody else has? Where do they have a credit card that I can acquire? And how can I give them a targeted offer at the right time in the right space? I think mobile, we've moved through web. We're kind of coming to the end of the apps phase, and we're now starting to see, you know, applications that bring together functionality and delivery the same way on multiple devices, online, in apps and in smartphones. And I think this year, among others, will be a big year in the mobile space. And in real time, the journey is the roadmap is clear. The journey that we're on is relatively clear, and we're just at the beginning of that, and we're going to move through that over the next 3 or 4 years in a couple of jumps. We see the path ahead as playing out in two ways: incremental innovation and disruptive innovation. Looking at incremental innovation, you know, small changes, small improvements, small reductions in friction and frustration often are effective at driving large amounts of behavioural change or large changes in consumer recognition of benefit. Amazon have been able to measure a 1% increase in revenue for every 100 milliseconds of speed improvement on their website. Looking at the example of Mint.com or all of those PFM tools, they're not doing anything that you couldn't do with a spreadsheet, collecting information from all of your bank statements and all of your statements, but what would take you 2 or more hours to do on a Sunday afternoon, they can do in 15 seconds, present those results back to consumers quickly. So, you know, incremental changes in current problems often produce big results. In the real world, people are unlikely to abandon a shopping trolley because of a 5-second delay in the checkout process, but online and at the point of sale, we already know that they're switching from one payment instrument to another because of the same 5-second delay. And NFC is a great example. So, you know, the research and the general trends are now that an NFC transaction takes about 15 seconds, whereas a chip and pin or swipe and pin transaction takes about 27 seconds. And this study from MasterCard Partners shows that once consumers have made the leap to NFC, they see a 30% increase in spend via NFC in the next 12 months as they did in the 12 months before they used NFC, which equates to about a $600 increase in incremental spend on that card as opposed to anything else. So small changes are producing big results. But we're also seeing disruptive innovation as well, and we've talked already about some of these examples. PayPal, of course, was the original disruptor, allowing anybody to send and receive money online, and Square has taken PayPal's money to the point of sale world. We'll talk in a second about Level Up. And Affirm, which is a new business that's just been launched by one of the original co-founders of PayPal, aims to make shopping using mobile or on the web a two-touch experience. Firstly, the merchant gets paid instantly, but the consumer is given 30 days to select which card they want to put that payment towards 30 days to decide whether they want to put that on this credit card or this debit card or on this PL. So, you know, there are lots of new entrants who are completely disrupting the payment space. One of the big reasons that they're doing that is because of the interchange models. We've seen a steady increase in the percentage of merchants who are prepared to surcharge, and we're also seeing that surcharging behaviour resulting in big changes about where consumers use their cards as a consequence, and we know that people will change as a consequence of surcharging. You know, there is resistance to surcharging from consumers, and there's resistance to paying merchant service fees from merchants, and that's driven changes. I think two changes in particular. The first of those is that the schemes have had to lower their NSFs in order to retain those merchants and to lower surcharging. But the second and bigger change is that it's driven the move of new entrants into the business of accepting and receiving payments, and not the existing players. So Dwell is an example that Scott, I think, talked about this morning. Their method is to pre-qualify cardholders and to use money to move money using direct entry. You know, with a 1 or 2 day delay, rather than using credit card surcharging. And here's an example from a site in the US that they use, and they're actually making transparent to the consumer that if you pay with this instrument, you know, this jacket will cost you $100, but if you pay with this instrument, you only have to pay $98.75. And they're seeing a real shift in cardholder behaviour as a result of saying to the consumer, you make the choice. Do you want to pay $100 for this, or do you want to pay $98? Level Up is another example. Their mission is to eliminate interchange completely. Their view is that moving money should be free. They charge merchants 0% for all payment processing and provide the Level Up hardware free of charge. When a customer pays $10, the merchant gets $10, no merchant service fee. How they get paid is they charge the merchant for acquisition of new customers. So if the merchant runs a campaign to attract new customers, they charge 40 cents for every dollar of loyalty credit redeemed by a customer on their first sale. So no cost for the campaign, no cost for impressions, no cost for lead generation that isn't successful. Only when a customer goes into a store and pays $10, Level Up takes $4 of that and passes the balance on to the merchant. This has been so successful in some merchants, and there's an example of a company there in the States called Sweet Green Rewards, which has got, I think, about 24 stores. It's been so successful that they've removed all of their existing merchant acceptance, and they will only accept payments by Level Up, which of course then has the benefit of driving cardholder take-up and driving people to say, well, if I can't use my Visa card, well, if you make me use this Level Up, I may as well download it. So it's having a real network effect. I think we're at the stage in the market where we're seeing lots of innovation, lots of new instruments, lots of people playing, often with somebody else's money. You know, things will succeed and things will fail. What there isn't at the moment is interoperability. There's a range of different instruments, none of which talk to each other, and that's what you'd expect to see at this point in the cycle. You know, in the case of NFC, we haven't seen alignment between the issuers, the schemes, the handset operators and the telcos, which is why we haven't seen NFC take off in Australia yet, but we will when that alignment happens. And it reminds me a lot about the way ATM started. You know, as many of you know, Queensland Teachers Credit Union was the first institution in Australia to offer an ATM. And there's no truth in the rumour that that's a young Michael Murphy. But originally ATMs were, were something new and something innovative. And then it moved from, I've got an ATM, to how many ATMs do I have? And who's got the most ATMs? And then, I think there's some of us in the room who are young enough to remember this. You used to start by only using one bank's ATMs, and then they formed interchange arrangements. I think initially NAB and ANZ joined up, and then Westpac and CBA joined up, and then those networks became more connected until ultimately you got to the point where you could use any ATM. And then we're now at the point where ATM usage is shrinking, so we're seeing consolidation of ownership of ATMs and moving towards more single owners. Will the same thing happen in mobile? When will we see all of these kind of range of players starting to consolidate their offerings so that consumers can interact between the two? In the real-time space, most of you will know that the RBA has mandated a timeline to move to central infrastructure around real-time payments by 2016. So all payments that are made on interbank will connect through one institution to a small piece of infrastructure in the middle that will move money in real time or near real time between institutions. At the same time, the second piece of infrastructure that they've talked about is a central addressing solution. So a central database that will link BSBs, account numbers, mobile numbers and email addresses so that you can make payments that are between people using that common address. Institutions like the CBA are already making that offer available to their customers, and they've built real-time switching infrastructure, and the CBA is large enough that they can market to their consumers the benefit of me being able to send money to another customer in real time, but it only gets there in real time if that customer is also a CBA customer. We'll see that move across the industry between now and 2016. The thing that I would point out is that we don't have to wait till 2016 to get there. So in December this year, the RBA will mandate a move towards having 5 settlements a day on business days. So we will see a move to near real time before we have to wait till 2016. We see that collaboration and ubiquity is the key. Regulator-led national infrastructure has appeared in other markets as well as our own. I think the solution to succeeding in this market is by collaborating and by being open to partnering with people as those schemes come together. From our perspective, we see our future as being relatively neutral, open, central player that will enable our customers to connect with all of these schemes and the new ones as they come along. We see 3 layers. We see it important to build the bottom layer, which we've largely now completed, which is about infrastructure that will support real-time processing and more frequent settlements. But that won't be enough. What will need to sit on top of that layer is value-add applications, and the one that comes to mind is a central database of email addresses or mobile phones, so that there's value to consumers in being able to move money between people. And then finally, what will sit on top of that is individual applications, and we've heard about things like Google Wallet, cardless ATM withdrawals, mobile banking, mobile payment solutions. Those will sit on the top, but the value to consumers will be the interaction between all of them. We see our role as being getting the foundation right, so all of the things that you see on the screen there all rest on the current card and payment processing infrastructure that's being used in Australia. There's a lot of value that can be created by various players by building applications that sit on top of that foundation. From our perspective, now that we've completed our own switching capability, our product roadmap focuses on growth through building on those through a number of key initiatives. Obviously, our focus is on mobile and supporting mobile payments, on real-time payments, on fraud prevention, on upgrading a ready ATM network so that it can support things like cardless withdrawals, being able to use a code and put that into an ATM and withdraw money without using a card. Some of the short-term things that we're looking at doing, obviously, in the PFM, the wallet space, supporting our customers to move into NFC, and also critically a move towards real time. In summary, how do we know what's next? I think there are three things. Watching for technologies that are having a positive impact on people's lives, and then bringing it back into our industry context. So if I can email data or email documents from one side of the world to another in near real time, then why can't we email a payment? So PayPal kind of understood that and built a platform for sending payments to email addresses instantaneously. Similarly, look for the gaps. What are the things that frustrate customers today, and what are our opportunities to reduce that friction and make those things quicker and more automatic through innovation and through automation? So rather than sitting going through bank statements and online statements looking at where I spent my money, Mint has provided opportunities to collect all of that information in real time and present that back to the cardholder. Critically, I think though, as leaders in our organisation, the third thing is the most important, and that's about, I think, what Scott talked about this morning. That's about creating the space to innovate. Being clear about the things that are not negotiable, and being clear about the electric rails that you can't touch, and the space to play in, but also enabling people in our business to innovate, to do things quickly, to make mistakes, to have a go, and to fail, but also to fail fast. And if we can do all of those things collectively, then I think we'll be in a much better position to respond to all of the innovation that we see in payments. Thanks.